What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone, brought to you by the Pulis Group. Today, we're going to discuss the importance of basis for partners in a partnership. So this could be you as a partner in a traditional operating business structured as a partnership, or you as a partner in a real estate syndication. So generally, your syndications are structured as partnerships for tax purposes. So what exactly do we mean by basis? Basis is the amount of your capital investment in property for tax purposes. So generally, this starts with your cost. This amount, the initial cost, is adjusted for items of income and expense in a partnership setting, as well as additional contributions or distributions, and as we'll see, partnership liabilities as well. Now, when dealing with a partnership, there is inside basis and outside basis. Inside basis refers to the partnership's basis in the assets it owns. Outside basis refers to the individual partner's basis in their partnership investment. So our focus today is on outside basis. Now, your outside basis as a partner is increased by the following items: contributions you make to the partnership, your share of partnership taxable income and gains, your share of partnership tax exempt income. So even though it's not taxable income, it increases your basis, and your share of any increase in partnership liabilities. Now, your basis is decreased by distributions paid to you, your share of partnership losses, your share of any partnership non-deductible expenses. So just like your basis is increased for tax-exempt income, any non-deductible expenses will also decrease your basis. And finally, your basis is decreased by your share of any decrease in partnership liabilities. So let's just talk through a very quick, simple example of what this looks like. So you contribute $25,000 to a partnership in exchange for a 25% ownership interest. During the current tax year, the partnership has $50,000 of taxable income. So your share of that, 25% of $50,000, is $12,500. And also during the year, the partnership makes a distribution to you of $15,000. Your basis at the end of the year is $22,500. That's your initial contribution of $25,000 plus $12,500, your share of the $50,000 of income for the year, minus the $15,000 distribution paid to you. So that's all we're doing, is it's tracking your share of these partnership items year by year. Now, I didn't include any liabilities in this example. We'll look at another example shortly. But your share of partnership liabilities also increase your basis. So an increase in a partner's share of partnership liabilities is treated as a contribution of money to the partnership, and it increases your basis. A decrease in your share of liabilities is treated similar to a distribution and decreases your basis. Now, there's really two key types of liabilities. There's recourse and non-recourse. This will become important a bit later as we talk about loss limitations. So recourse liabilities are those where partners are on the hook for the debt if the partnership doesn't pay. Non-recourse liabilities are those where no partner individually bears the economic risk of loss. It's just the partnership itself. So the creditor is at risk if the partnership doesn't pay. They can't go after the individual partners. Recourse debt they can. Now, when real estate is involved, it actually opens up a third type of debt called qualified non-recourse debt. This becomes important for determining at-risk amounts, which we'll discuss shortly. But qualified non-recourse debt just means it involves real estate and the debt itself is secured by the real estate. So think of a mortgage on your home. But in this case, we're talking about real estate owned by a partnership, and the debt, the non-qualified recourse, or the qualified non-recourse debt, is secured by the real estate itself. Now, you might wonder, why is basis important? Your basis in an asset is used to calculate your gain or loss if you ever dispose of it. So your basis plays a role in any gain or loss on the sale or disposal of your partnership interest. Also, any losses passed through to you by the partnership are limited by your basis. You cannot deduct losses in excess of your basis. If you have losses in excess of your basis, they're suspended and carried forward until there's sufficient basis to absorb the loss. And finally, if you receive a distribution in excess of your basis, that's taxable income. It's taxable as a capital gain. So there are 3 levels of loss limitations, and they go in the following order: basis, at risk, and then passive activity losses. So number 1, you first start with your basis. Losses are first limited to your basis. If you have sufficient basis, great. That doesn't necessarily mean you can take the loss. Next, you have to look at your at-risk amount. So remember, in basis is included the partnership liabilities. Your at-risk amount, this is assuming you have sufficient basis to take the loss. Next, we're going to look at your at-risk amount. This is similar to your basis, but in this case, the only liabilities that count as being at risk are those you're personally liable for, so your recourse liabilities. Now, an exception to that is qualified non-recourse debt, which we just talked about. So that's where the debt is secured by the real estate. So this comes into play when real estate's involved with the partnership. After the at-risk limitation, now you have to look, is the activity considered a passive activity? So as you all probably know, even if you have sufficient basis and at-risk amounts, if the activity is passive, your passive losses can only be offset by passive income. Now, there's some exceptions. So, for example, a real estate professional status allows you to deduct losses from rental real estate. Now, technically what it does is it changes that passive loss from passive to non-passive, but it kind of gets you out of that passive bucket. So let's take a look at an example of how this would work. We're going to use a hypothetical syndication real estate investment. So year 1, you invest $100,000 into a syndication. Let's say they're doing a value add deal for an apartment complex. They run a cost seg study. Your year 1 K1 shows a loss pushed out to you of $80,000. They've used debt, so you have a share of the partnership liabilities, $50,000. We're going to say it's qualified non-recourse debt, which it probably is in this case. At the end of year 1, your basis or at-risk amount, which includes the qualified non-recourse debt, is $70,000. That's your $100,000 investment minus $80,000 of losses passed through to you. But you get to use your share of the qualified non-recourse debt, which is $50,000. Now let's say in year 2, you have losses again, $50,000. We're going to assume no change in debt, just to keep it simple. Now you have $20,000 of basis and $20,000 at risk because it's qualified non-recourse debt. That's your $70,000 from the end of year 1 minus the $50,000 current year loss. The amount is $20,000, but you've received $130,000 of losses so far based on your $100,000 investment. And you still have $20,000 at risk due to the qualified non-recourse debt. Assuming you have some other passive income out there, you can deduct that entire $130,000. Now, the trade-off is at some point there's going to be an exit and you're going to have larger gains. But with the time value of money, it's better to take the loss now if you can. Now, if this is a passive investment and you do not have other passive income, then those losses are still going to be suspended because the passive activity loss rules will prevent you from deducting passive losses. So to summarize, your basis in a partnership or a syndication is your initial investment adjusted for your share of income and losses, changes in partnership liabilities, plus any distributions or contributions made during the ownership period. It's important because distributions in excess of your basis will be taxable as capital gains. Also, your basis is going to determine whether or not you can deduct losses. Losses in excess of basis are not allowed. They're suspended and carried forward. Even if you have sufficient basis, you need to be aware that you also need to consider the at-risk rules and whether the activity is passive or non-passive. So that about does it for today's episode on the importance of partnership basis. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.